Imagine having like a crystal ball for your investments, knowing exactly which bit of the economy is about to boom, which part's going to stall out. This whole promise of sector rotation, it sounds a lot like that, doesn't it? The idea
Yeah.
you can just perfectly time your money with the ups and downs of the economy, grabbing those gains just when they happen. But is it really a solid path to beating the market? Or is it maybe more of an illusion, something
Yeah.
that sounds great but is really hard to pull off?
Yeah, that's a really powerful way to put it. And it really gets right to the heart of this sector rotation ideas, this notion that you can like actively shift your portfolio around, move your money between different industries, tech, healthcare, energy, financials, whatever, because you think you know which ones are set up best for what's happening in the economy right now. It's basically a type of market timing, isn't it? But focus just on sectors. And that's exactly what we're diving into today. Industry rotation. Is it a workable strategy for U.S. investors?
Right. And the basic idea, it feels really intuitive. Different parts of the economy just react differently when things speed up or slow down overall. Makes sense. When the economy's picking up, some businesses just thrive. When it's slowing, others are maybe more stable. So for this deep dive, we've gathered quite a bit of material. We've got some heavy-duty academic research looking at decades of U.S. market data. And we've also got more recent stuff, commentary talking about the sector shifts happening, well, pretty much right now as things played out in early 2025.
Yeah, and our goal here is really to pull all of that together for you. We want to break down the theory, matching sectors to the business cycle. Then we need to square that theory with what the actual historical data says happened. We'll look at the recent example of the rotation we've just seen play out, and ultimately kind of use all these pieces to figure out, does this strategy really give you an edge? Or are the real world problems just too big to overcome consistently? This whole deep dive, it's about trying to cut through all that noise and get to the essential insights for you.
Okay, let's do it. Let's unpack this. Maybe start with the basics. Lay out the theory first. What exactly is sector rotation, and how does it link up with this idea of the business cycle?
Okay, so fundamentally, sector rotation is an active investment strategy. It's not just building a diversified portfolio and sitting on it. No, someone doing sector rotation is trying to predict which specific sectors or industries are probably going to do best in the, let's say, near future. And then they concentrate their money there, pulling back from the sectors they think will lag behind. The whole point is trying to get better returns than the overall market by being in the right place at the right time.
And the right time is determined by where we are in the business cycle. That's the timing mechanism.
Pretty much, yeah. That's the core belief, that different economic weather favors different kinds of businesses. A company selling, say, basic necessities might hold up okay in a recession because people still need that stuff. But a company selling luxury cars or big industrial machines, they probably need a booming economy, right? When people and businesses feel confident and are spending, the strategy assumes these links are predictable enough that you can actually profit from them.
Okay, so the theory maps specific sectors to different phases of the economic cycle. How do people usually define that cycle for this kind of strategy?
Well, for looking back historically, and sometimes for building models, there's the National Bureau of Economic Research, the NBER. They're the official scorekeepers, you could say. They declare the start and end dates of U.S. recessions based on a whole bunch of economic data. So they define the big picture, expansion, contraction. But, and this is really important, the NBER announcements, they often come way after the fact, months later sometimes. So great for historians looking back, but trying to use their official calls to trade stocks in real time, that's super challenging. The market has probably already moved long before they make the call.
Right, so NBER dates are backward looking. Not much help for today's decisions, which is why these popular sector rotation models often use a more detailed breakdown of the cycle.
Exactly. The NBER gives you the big swings, expansion and recession. But investors often use a more fine-grained model, typically breaking the cycle into 5 stages. This makes sense because historically, expansions last a lot longer than recessions. If you look at the data, say from 1948 to 2018 here in the US, expansions averaged around 5 years. Recessions, much shorter, maybe 10 months on average. So that 5-stage model lets you be a bit more specific about what might be happening during those long expansion periods.
And within that 5-stage model, there's this conventional wisdom, right? A popular belief about which sectors are supposed to lead in each phase. What does that map look like? It's almost like a playbook people follow.
It really is treated like a playbook sometimes, yeah. It gets cited a lot in investment strategy discussions. The sources mention classifications, like one often attributed to Sam Stovall, that lay out this popular guide. Let's walk through it. So stage I, Early expansion. This is when the economy is just pulling out of a recession. Growth is picking up. Things are starting to look better. The common thinking is you want the sectors that are most sensitive to this rebound, the ones that got hit hard but bounce back fast. So think things like technology, especially software, electronics, measuring and control stuff. Companies start spending again. Innovation picks up. Transportation is another one. Shipping, autos, more goods moving, people buying cars again, and financial banks, insurance, real estate, trading, lending increases, asset prices recover, more deals happening. The idea is these cyclical sectors lead the charge out of the downturn.
Okay, that makes sense. Then as the expansion matures, it's not stalling, but it's established. Does the expected leadership shift then?
That's the theory, yeah. Stage 2, middle expansion. The idea is the focus moves to sectors that kind of form the backbone of sustained growth, industries that support ongoing activity. So the popular guide points towards basic materials, chemicals, steel, mining, the stuff needed to make other stuff. Also, capital goods machinery, electrical equipment, aircraft, things like shipbuilding, railroads. Businesses are investing now, building capacity, becoming more efficient. And you also see personal and business services in there, reflecting just continued growth in spending and corporate activity. These are the workhorse industries of a solid expansion.
Okay, makes sense. And then stage 3. Late expansion. The economy's maybe running hot, potentially peaking, or maybe people are starting to worry about a slowdown coming. What's supposed to lead then?
Right, so here the thinking often shifts a bit, maybe towards sectors that are less sensitive to the absolute peak or ones that just benefit from the overall strength that's already built up. You see consumer staples here, food, drinks, tobacco, basic household stuff, things people buy pretty much regardless. While they're seen as defensive, a strong economy certainly doesn't hurt their sales. Healthcare is often pegged for this stage 2. Hospitals, drug companies, medical devices. Demand is pretty steady, plus ongoing innovation. And energy, oil, gas, coal. That often gets mapped here too. Maybe benefiting from high demand during peak economic activity, although obviously very sensitive to commodity prices. So it's kind of a mix, some stability, some sectors that might hold up, even if growth starts to flatten out.
Then comes the turn, stage 4. Early recession. The economy starts contracting. What does the playbook say now?
This is when the conventional wisdom shouts defense. You want sectors providing essential services that people absolutely need, even when money's tight. The classic examples here are utilities, gas, electric, and telecommunications. People need to keep the lights on, heat their homes, use their phones, right? The economy shrinking or not. These sectors are expected to provide some stability, maybe more predictable earnings, during that initial downturn phase.
And the final stage, stage V, late recession. The economy's still weak, but maybe there's light at the end of the tunnel. People are starting to think about recovery.
Exactly. So in late recession, the popular guide suggests starting to position for the next upswing. This often means looking at sectors that are really cyclical, the ones that got hammered the most during the recession, but could bounce back strongly when things turn around. They might offer good value at this point. So you see consumer cyclical sectors here. Apparel, textiles, maybe retail, restaurants, hotels. The thinking is consumer spending will eventually rebound. And financials might pop up again here too. They could benefit from potential interest rate cuts designed to boost the economy, and they're positioning for more activity when growth returns. It's about trying to get in early, anticipating the next expansion.
You know, listening to that, it really does paint a very clear, logical picture. It feels right. It seems like it should work, that different industries would naturally do better at different times. It gives you this, roadmap that seems grounded in how the economy actually works.
Oh, absolutely. The intuitive appeal is incredibly strong. It provides what seems like a rational framework for trying to time your investments based on the economic ebb and flow. But, and this is the big but, as the sources dig into the data, especially the academic research, we have to move from this appealing theory to the, often much messier reality of whether it actually holds up consistently over time.
Okay, which brings us right to the empirical evidence, the reality check. Let's shift from the nice, neat theory to the hard numbers. We have this academic research that specifically tested this popular belief over, 70 years of U.S. market history, from 1948 to 2018. How did they do it? And crucially, what did they find when they put this conventional wisdom under the microscope?
Right, this is where theory meets data, and it gets really interesting. The researchers basically analyzed how different industries performed across these different business cycle stages. And they were careful. They used a few ways to define the stages. They used the official NBER recession dates, but also things like the Chicago Fed National Activity Index, the CFNAI. That's a broader index trying to gauge economic activity in real time. This let them test the sector rotation idea, using different timing assumptions. And they looked at returns for a whole bunch of industries, using standard classifications like the Fama-French industry groups.
Okay, so first things first. Did the data even show that industry performance varies across the stages? Is that basic premise true?
Yes, absolutely. The data clearly shows that. Table 4 in the research confirms it. Most industries show statistically significant differences in their performance depending on the stage of the business cycle. So the fundamental idea that sectors aren't all the same, that their returns are influenced by the economic environment, that part holds up. Performance does vary.
Okay, variation exists. Got it. But here's the critical question for someone trying to use this strategy, right? Does that variation mean sectors reliably outperform the market specifically during this stage the popular belief says they should?
And this is where the results start to get, well, pretty surprising and challenging for that popular rotation model. Just looking at simple nominal returns, raw returns, not adjusted for risk yet in Table 4, the study found something striking. Only about 60% of the industries actually had higher returns than the overall market during the stage they were expected to outperform based on popular belief. Just think about that. 40% of the time over this huge stretch of history, the favored sectors didn't even beat the market average in their supposed sweet spot.
Wow, okay. That's already a pretty big dent in the theory.
Yeah.
But I remember reading it got even more counterintuitive when they looked at the average performance of the groups of industries expected to do well in certain stages.
Absolutely. And this is maybe the most eye-opening finding. The researchers calculated the average monthly return for all the industries lumped together that were supposed to do best in each stage. So take early expansion, stage 1. The industries expected to lead the charge. Their average monthly nominal return over the whole 1948-2018 period was 1.12%. Now compare that to the overall market's average return during those same early expansion periods. That was 1.30% per month.
Wait, so the very sectors picked by the popular guide to lead the market out of recession on average actually underperformed the market during that early expansion stage by nearly 0.2% per month.
Exactly. That's what the data showed, a significant finding. And it wasn't just early expansion. Look at middle expansion, stage 2. The industry's supposed to shine then. Their average monthly return was 0.93%. The market's average in middle expansion, 1.06%. So again, they underperformed on average by 0.13% per month. Over this incredibly long period, the conventional wisdom for picking winners in the two main expansion stages actually pointed to sectors that, on average, lagged the market during those exact times.
Wow, that just flies directly in the face of the core idea of the popular guide, doesn't it? Especially for the longest parts of the cycle, the expansions. It suggests that just buying the right sectors for the expansion stage, on average, actually put you behind the overall market back then.
That is precisely what this historical analysis suggests for those expansion stages. And another point, highlighted in Table 4, is that individual industries generally have higher volatility, bigger price swings than the broad market index. So chasing these sector returns often means taking on more risk than just owning the market.
Okay, so nominal returns were often underwhelming, especially during expansions. But maybe risk explains it. What about risk-adjusted performance, using things like alpha? Does accounting for the risks these sectors carry reveal any consistent extra return, any alpha, during their expected good times?
Right, this is the real so what for investors. Table 5 in the research tackles exactly this. They use several risk-adjusted metrics. Jensen's alpha, the Fama-French 3-factor alpha, which looks at market size and value risks, and the Carhart 4-factor alpha, adding momentum. These models try to figure out if a sector is delivering returns above and beyond what you'd expect, just given its exposure to these well-known systematic risks.
And the results here were even less supportive of the popular sector rotation strategy.
Yeah, significantly less. The research found very little evidence of statistically significant risk-adjusted outperformance. So positive alphas that were strong and consistent enough to look like real skill, not just luck. Just looking at simple excess returns over the market in Table 5, only 7 out of 48 industries showed statistically significant positive results in their expected stage over the whole period. That's not many. And when they applied the more rigorous Fama-French and Carhart models, which check if the returns are just payment for taking on specific risks, like being small cap or value-oriented, the number of industries showing significant positive alpha in their expected stage, it dropped even lower.
Okay, so let me make sure I understand this. The data shows performance varies, yes. But it's not showing that this variation consistently translates into reliable, risk-adjusted extra returns in the specific stages predicted by the popular models. It sounds like whatever extra return you might have gotten was probably just compensation for the inherent risks of those sectors, not some bonus from cleverly timing the business cycle using the playbook.
That's exactly the key takeaway from the risk-adjusted part. It suggests the performance wasn't really alpha skill from timing. It looked more like beta, just reflecting the sector's sensitivity to the broad market or other known risk factors like size or value, which just happened to show up more in certain economic conditions. Interestingly, the few significant positive alphas they did find were often concentrated in the recession stages, early and late recession averages in Table 5. Which might suggest maybe there's some potential benefit in defensive positioning or trying to anticipate the rebound, but it definitely doesn't validate the whole 5-stage popular model across the entire cycle.
So, given that individual industries struggled to show consistent alpha in their right stages, what happened when they simulated an actual strategy, a hypothetical portfolio that just blindly followed the popular belief, rotating sectors based on the stage? How did that perform over the whole 1948-2018 period compared to, say, just buying and holding the market?
Yeah, the study did exactly that simulation. They assumed perfect knowledge, knowing instantly which stage the economy was in, and switched the portfolio into the sectors mapped to that stage by the popular guide. This is in Table 6, Panel A. The result. This perfect timing sector rotation strategy had a mean monthly return of 1.00%. Its standard deviation, or volatility, was 5.02%. Now compare that to the overall market, 0.89% mean monthly return, but with lower volatility, 4.23%.
Okay, so a tiny bit higher average return on paper with perfect timing, but noticeably more bumpy, more volatile.
Correct. And when you calculate the Sharpe ratio, which measures return per unit of risk, so higher is better, the market had a Sharpe ratio of 0.21. The popular sector rotation strategy, slightly lower at 0.20. This suggests that tiny bit of extra return you got, even with perfect timing, wasn't actually enough to compensate you for the extra risk you took on compared to just holding the market index.
And how did it compare to just the simpler market timing strategy, like just being in stocks during expansions and switching to cash during recessions, again, assuming perfect timing?
That simpler timing strategy fully invested in stocks during NBER expansions, fully in cash, like T-bills, during NBER recessions, also assuming perfect real-time knowledge, actually did better in their simulation. It generated a mean monthly return of 1.04%, had even lower volatility, 3.99% standard deviation, and a higher Sharpe ratio, 0.26, than both the market and the popular sector rotation strategy. This is a really crucial finding. Even with the fantasy of perfect foresight, a much simpler timing strategy, stocks versus cash, beat the sector rotation approach based on popular beliefs.
Man, that really drives home the practical problems, doesn't it? The theoretical edge of sector rotation, even if you could capture it perfectly, seems razor thin and maybe not even worth the extra risk.
Exactly. And the study really hammered this point home when they looked at real-world frictions, which is in Table 7. They found that the tiny theoretical outperformance of the popular sector rotation over buy and hold with perfect timing was just 0.11% per month. That's a really small edge to start with. And that tiny edge, it vanished or even turned into underperformance as soon as they factored in realistic transaction costs, the cost of actually trading between sectors. Plus, if the timing was even slightly off, say you missed the turn of the cycle by just a month or two, the performance also tanked quickly, often falling below just buying and holding. The simpler market timing, stocks versus cash, had a slightly bigger theoretical edge, 0.15% monthly, with perfect timing, making it a bit more robust to mistiming, but still vulnerable to costs.
Okay, so the bottom line from the empirical evidence, looking back over 70 years, is a pretty strong reality check for this appealing theory of rotating sectors based on popular business cycle models. Sectors do perform differently, yes, but reliably turning that into market-beating returns through timing, it's been extremely hard historically. The small potential benefit seems easily swamped by real-world stuff like trading costs and just how incredibly hard it is to get the timing exactly right.
That's really the synthesis, yeah. The research strongly suggests that the consistent, reliable alpha, the extra return from skill, just hasn't been there over the long haul for timing sectors, according to that popular playbook. And they really kicked the tires on this. It wasn't just one model or one set of industries. They checked using different ways of grouping industries, like the broader 10 sector or 23 industry GICS classifications. Table 6, Panel B. Same story. The popular rotation strategies didn't perform significantly better, or sometimes performed worse. They even tried using a more sophisticated economic indicator, the CFNAI index, to try and time the 5 stages more objectively. But that strategy actually underperformed the market quite a bit. It's 0.73% S is 0.89% monthly return, Table 6, Panel C. And one last thing they looked at, if one sector's performance could reliably predict another's, Figure 5, the results looked pretty much like random chance, no predictable domino effect in sector leadership.
Okay, let's just process that for a second. The academic view, based on a huge amount of data, is pretty clear. While sector performance does vary with the economy, trying to use standard models to time those shifts for consistent extra profit has historically been, well, largely ineffective once you account for risk and costs. It really seems the market is just way more complex, maybe more efficient than those simple models assume.
That's the critical takeaway from the historical data, I think. That straightforward, intuitive story of Sector A wins in Stage 1, Sector B in Stage 2. It just hasn't consistently played out in a way that generates reliable, risk-adjusted profits for investors trying to trade on it over the long run. The signals are noisy, the timing is incredibly difficult, and the costs really matter.
Okay, so having absorbed that powerful historical perspective, let's pivot to what's been happening much more recently, because the market never stands still, right? And for a few years leading up to 2025, we had this incredible situation where gains were really concentrated in one specific area. Growth stocks, especially those massive tech companies, the Magnificent Seven.
Absolutely. That period was really defined by that concentration. A relatively small handful of giant tech and growth stocks were just driving the bus for the whole market. I mean, just look at 2024 U.S. tech stocks returned something like 36%. That's huge. And it accounted for a disproportionate amount of the S&P 500's overall gain, if you happen to be loaded up on those few names that you feel like a genius.
But then, and this is where it gets really interesting for our discussion today, as we got into 2025, things started to shift. We began seeing a very real, tangible example of sector and style rotation happening right in front of us. By early March 2025, the numbers were pretty stark, weren't they? Showing a real change in leadership.
Oh, definitely stark. The year-to-date figures around March 6, 2025 showed this clear split. The NASDAQ, which is packed with those big tech and growth names, was actually down over 6% for the year so far. Now contrast that with the Russell 1000 Value Index representing value stocks. That was up almost 1.9%. And maybe even more telling, international stocks using the MSCI EAFE index as a proxy were up a huge 11.2% in just over 2 months.
Wow, that is a massive difference in performance over a pretty short period. It really highlights how quickly the market's focus can shift. A really powerful recent example of capital moving around.
It really is. It shows leadership isn't set in stone. In early 2025, the sectors driving the market weren't those familiar tech giants. We saw areas like financial services, energy, industrial sectors, often seen as more value-oriented or tied to the traditional economy. They started to outperform high-growth tech. That's a really noticeable rotation away from where the leadership had been so concentrated.
And actually, thinking back to 2024, even while tech was grabbing headlines, some of these other areas were already showing strength, weren't they? Financials were up over 30%, communication services over 34%, even utilities had a decent bounce back, maybe hinting that the market was already broadening out a bit before the big 2025 shift.
That's a really key observation. This shift didn't just appear out of nowhere in January 2025. It was kind of foreshadowed by improving market breadth, starting in the second half of 2024. Remember how for a while it felt like all the S&P 500 gains came from just those Magnificent Seven? Well, by late 2024, their contribution to the index's total gain had dropped quite significantly. That meant a wider range of stocks across different sectors were actually starting to participate in the rally. The base was getting broader.
And why is that improved market breadth considered a good sign? What does it mean for you as an investor watching this?
Well, generally, a market rally driven by just a tiny number of mega-cap stocks can feel a bit fragile, maybe less fundamentally sound than one where lots of companies and industries are doing well. So improving breadth often suggests that confidence is spreading beyond just a few perceived winners. It can indicate a healthier market foundation. And for you as an investor, it's a signal that the game might be changing. Success might start requiring more selectivity, more discrimination, as the sources put it, finding opportunities across a wider field rather than just jumping on the bandwagon of a few dominant stocks. It suggests that maybe diversification, after potentially lagging during the concentrated rally, could be starting to become more important again.
So what were the main things driving this recent rotation, according to the market commentary we looked at?
It seems tightly linked to the shifting economic story and changing expectations. A big one is always the outlook for interest rates. If people start thinking rates might stay higher for longer than previously expected, that can sometimes make value stocks look more attractive relative to growth stocks, whose earnings are further out in the future and get discounted more heavily by higher rates. Or if worries about a recession start to creep up, you might see money flow into classic defensive sectors like consumer staples or healthcare. But then on the other hand, if the job market stays surprisingly strong, like it has been, that supports consumer spending and company profits, which tends to be good for more cyclical sectors.
So you get this really complex mix of signals, right? Maybe some signs growth is cooling off, but hey, the jobs market is still really robust. That must create a tricky environment for investors to navigate.
Absolutely. It's exactly this mix of signals that leads to these complex, sometimes quite fast, rotations. Investors are constantly trying to position themselves based on these maybe conflicting indicators. They might be hedging against a possible slowdown with some defensives, but they also don't want to completely miss out if the economy manages a soft landing and avoids a bad recession, so they keep some exposure to cyclicals. Every new piece of data on inflation, jobs, GDP, it keeps triggering these adjustments and shifts as the market reevaluates the odds.
And how did the sources describe the general mood among investors during this period of rotation and changing leadership?
It was characterized as cautious, but definitely not bearish. Maybe optimistic, but in a more balanced way. After the huge run-up, especially in large cap growth, there's a sense that maybe some parts of the market are looking a bit stretched, valuation-wise. So that leads to some prudence, maybe taking some profits, looking for better value elsewhere, which fuels the rotation we're talking about. But there's still this underlying belief, it seems, that the overall bull market might have legs, just maybe with different sectors or styles leading the pack going forward.
So portfolio managers aren't necessarily running for the hills, but they are actively moving money around, looking for better spots.
Yeah, that's the picture painted by the commentary. They're rotating their exposures, trying to find the best relative value, given the current economic picture. And many strategists were quoted saying they expect this rotation theme to continue through 2025. They see potential for value stocks, maybe some previously unloved sectors, to play a bigger role, especially if growth does moderate or bond yields stay relatively high. I think commentary from BlackRock specifically mentioned a compelling case for large cap value in this kind of environment.
You know, this whole recent rotation story, even though we can see it clearly now, looking back a few months, it really underlines that challenge we talked about from the academic research, just how hard it is to predict the exact timing and extent of these shifts before they happen.
It really does. Even when there's a clear theoretical reason linked to the economy changing, knowing precisely when the rotation will kick in, how deep it will go, and which specific stocks or subsectors within those broad categories will actually lead the way, that's incredibly difficult to nail down in real time. So this recent experience in 2025 just reinforces that academic finding. Trying to consistently time markets or sectors based on models, however logical they seem, is a really, really tough proposition.
Which kind of brings us to a slightly broader point about just the general complexity and riskiness of finance and investing, even beyond trying to time sectors perfectly. The sources we looked at touched on other challenges investors and companies face, and while they aren't all directly about sector rotation, they do paint a picture of a pretty complicated world out there.
That's a really important perspective to keep. The difficulty we saw in reliably timing sectors based on the business cycle, that difficulty exists within this much larger, very complex financial ecosystem. For instance, the sources briefly mentioned strategies aiming for absolute returns. These often use complex tools derivatives, leverage trying to make money whether the market goes up or down, but they come with a whole host of their own risks, right? Things like lack of transparency, potentially high fees, worrying about your counterparty, and just being totally reliant on the skill of the manager running the strategy. These are way more complex than just rotating sectors, but they also highlight how hard it is to generate consistent returns outside of just riding the market.
Yeah, or think about the risks just within regular corporate finance, like companies buying other companies or investing in startups through corporate venture capital. The sources hinted at challenges there too. Getting M&A right is notoriously difficult. How do you accurately value the company you're buying? How do you mesh two totally different company cultures and IT systems, especially if you're paying with stock? And will those promised synergies ever actually show up? Huge risks involved. And corporate venture capital investing in new tech faces its own hurdles, like really uncertain or long-term payoffs and maybe conflicting goals with the main company's business.
Exactly. And even things that seem further afield, like managing inventory with bill and hold sales or making sure your A/B tests for a new website feature are actually statistically valid, or protecting intellectual property in 3D printing. All these examples just point to the same underlying truth. Accurately figuring out value, managing expectations, controlling processes, predicting outcomes, whether in business operations or financial markets, is rarely simple or certain. There's always complexity, risk, and uncertainty involved.
Right. We don't need to dive deep into the weeds of, 3D printing law or A/B test statistics here. But the point is, the whole financial and business world is just layered with these complexities and risks, from the macroeconomy right down to how a single company operates.
Precisely. And when we bring it back to sector rotation, the empirical data we discussed show that even this strategy, which seems logical and tries to simplify one aspect of timing based on the business cycle, faces huge practical hurdles. Historically, those hurdles have made it really tough to use it as a reliable way to beat the market. Trying to time those shifts just adds another layer of difficulty and potential for error onto an already complex and risky backdrop. It really underscores that successful investing often seems less about making perfect short-term predictions and maybe more about building an approach that's resilient and can handle all this complexity and uncertainty over time.
Okay, so let's try to pull all these threads together. We've got the appealing theory of sector rotation, but the tough empirical evidence challenging it over decades. We have the difficulty shown by that data. We have this very clear, real-world example of rotation happening right now in 2025. And we have this broader context of financial complexity and risk. What's the big overarching takeaway here? What's the critical lesson for investors listening to this?
I think the key takeaway, the thing that's just powerfully reinforced by both the long-term history and the very recent market action, is the absolutely critical, enduring importance of diversification.
And that recent 2025 rotation from super concentrated growth stocks to value and international, it serves as almost a perfect living example of why that principle matters so much, doesn't it?
It couldn't be clearer, really. For several years, if you were heavily tilted towards those few magnificent 7 stocks and U.S. large-cap growth, you were massively rewarded. It would have been easier to start believing that was the only game in town. But the speed and the size of the shift we saw in early 2025 just hammers home the risk baked into that kind of concentration. Market leadership doesn't last forever. It can change, and as we just saw, it can change really quickly and quite dramatically. Yeah. If you were too concentrated, you could have been left quite exposed.
So diversification isn't just some abstract textbook concept. It's a practical tool for dealing with this constant change, and the fact that timing these shifts is so darn hard.
Exactly. Diversification. And we mean spreading your money not just across different companies, but really importantly, across different sectors, different styles like growth and value, and different parts of the world like the U.S. and international markets. It's not a magic wand. It won't guarantee you never lose money. And yeah, it probably means you won't capture 100% of the upside if one tiny market segment just goes absolutely parabolic. But what it does give you is resilience. It's a strategy designed to help you weather these inevitable rotations in leadership. It reduces how much you depend on any single part of the market doing well at any one time. And crucially, it keeps you in the game, positioned to potentially benefit from opportunities wherever they pop up around the world, instead of needing to perfectly guess which narrow area is going to be the next big winner.
And the sources really underlined this point, didn't they? Saying that investors who were more diversified likely found it much easier to weather the shift much more comfortably than those who were all in on the previous leaders.
Yes, they did. And they reinforce that broader idea that diversification across different types of assets and geographies is widely seen as the most reliable path to long-term financial success. Look, the historical data shows how incredibly difficult sector timing is. The recent market action shows how fast leadership can flip. Combine those insights with the fact that the financial world is just fundamentally complex and unpredictable. And diversification really emerges not just as like one option among many, but as a core foundational principle for building a portfolio that can actually withstand the market's twists and turns over the long haul. Change is the only guarantee in markets, right? Diversification helps turn that constant change from being just a threat, oh no, I'm caught in the wrong sector, into something you can potentially navigate and even benefit from, as different parts of the global market have their moment in the sun over time.
Okay, so let's try to sum up our deep dive today. We started with the appealing theory of sector rotation, linking investments to the stages of the business cycle. But then we confronted that with the empirical evidence, spanning decades of U.S. market history, which really highlighted the significant challenges in actually making that strategy work consistently based on the popular models. The data suggests that generating reliable, risk-adjusted outperformance by timing sectors has been incredibly difficult, often leading to results no better and sometimes worse than simpler approaches like buy and hold, especially once you factor in real-world things like costs and the near impossibility of perfect timing.
Then we shifted to the very recent market action in early 2025. This gave us a clear, current example of a major rotation actually happening, a move away from concentrated U.S. large-cap growth towards value stocks and international markets. And this recent shift seems driven by changing economic expectations and is contributing to maybe a healthier, broader market participation.
So hopefully this deep dive has given you, our listener, a more informed, maybe more nuanced view on sector rotation. You can appreciate the logic behind the theory, but also really understand the practical difficulties that both the long-term research and the recent market behavior have highlighted. It's about getting beyond the simple story to the empirically grounded reality.
And maybe the most important takeaway is that while trying to predict these short-term market shifts is notoriously hard, the principle of broad diversification remains a really powerful and, historically, much more reliable tool for navigating all this market complexity and working towards your long-term financial goals.
So here's a final thought, something provocative for you to mull over as you think about all this. If even trying to perfectly time sectors based on well-defined economic stages, using popular models that have been around for ages, struggles so much to consistently add value over decades once you account for risks and costs, what does that really tell us about the power, maybe even the necessity, of just embracing all that market complexity and constant change through broad, resilient diversification instead?
Definitely something worth thinking about as you look at your own investment approach.
Indeed it is. Until the next deep dive into the sources you've shared.
Keep learning and stay curious.